Well, hello everyone. It's August 16th. It's Friday. What a week, right? I mean, we saw ups, we saw downs. The stock market was down 800 points on the Dow at one point. It's been a volatile week. So, Fed data has been neutral. There's been nothing really crazy. The only really negative or disturbing factor is the inverse yield curve between the 10-year and the 2-year bond. But it's not a huge inverse curve, and there's a lot more. You can't take it in isolation. There's a lot more to the economy. There's a lot more Fed data. There's employment growth. There's interest rates. So you got to look at everything together. So U.S. home construction fell by 4%. Not a huge number, but it is the third monthly decline in a row. So there could be a little trend developing. Now, keep in mind, home construction has been booming the last couple of years. So a little minor slowdown is not a big deal. Here is what I wanted to show you. This is really interesting. This is the put to call ratio for the entire stock market. This tracks the number of open puts divided by the total number of open calls. And what this does is, this is a rubber band indicator. It gives us it's actually not a very useful indicator when the numbers are near 100. But when you see something above 115 or when you see something below 80, that's when you know that rubber band is stretched out and the market needs to pull back. And yesterday we went as high as 125 and we cooled off. And anytime we're above 115, anytime we go above this level here, as you could see, we did a few days in a row, and we did over here back in end of May, almost beginning of June and beginning of May, it tends to revert back down. And what we're seeing right now is a reversion, is that rubber band snapping back from panic selling. When you're seeing the put to call ratio near the 125, 120 level, that means sellers are in panic mode, okay? And right now, we're coming down, and I believe over the next few days, we're going to go back to neutral level, which means the stock market is due for a bounce up. Now, let's look at the futures to see how we're doing right now. All right. Let's look at the E-mini. The Dow is up 229 pre-open. We're going to be opening in about 45 minutes. The S&P's up 25 points, almost a full percentage point, 0.90 or so, give or take. Let's look at the settings here. Let's change it to candlestick so you can get a better view of this. And also, let's look at a few studies. This is the 5-year chart. Let's look at the 6-month. Notice the red line is the 200-day moving average. The blue line is the 50-day moving average, and we're right in between the 50 and the 200-day. It looks like we tried to hit the 200-day and bounced off. The odds are, based on what I'm seeing here, based on the put-to-call ratio, being really, really oversold the last few days and being in panic mode, I believe the stock market's going to continue bouncing higher. And there's a good chance before the end of next week, we'll hit the 50-day moving average once again. Now, here's the question. Are we going to go bullish again? Well, till we hit the 50-day moving average and trade above the 50-day moving average 2 days, I want to see a closing 2 days completely above the 50-day moving average. I want to see a close like right here, 2 days straight. Till we see that, we're in twilight zone. Twilight zone meaning we're between the 50-day moving average and the 200-day moving average, and there's a good chance we're going to keep moving back and forth. But with the put-to-call ratio showing grossly oversold price level or panic level, there's a good chance we'll rally. And lastly, I want to look at the VIX. This is the short-term fear index. And anytime it's above 20, it means there's panic in the markets. And right now, notice we're right at that edge. We're right now at 1965 pre-open. Actually, I believe that's where we closed. So the market's about 200 points higher on the Dow. So the odds are we're going to open a little lower on the VIX, and that's a very positive sign. All right, let me look at one more thing here before I let you go. Here's the overnight VIX futures here. Yeah, and it's down overnight about, it's down overnight. So yeah, we're looking for a lower VIX. As long as the VIX is below 20, And as long as the put to call ratio continues going lower, weaker, gets weaker and goes right here towards the 1 level or below 1, the market is stabilizing and bulls are gaining control again. I hope you have a great weekend, and here are the levels you should be looking at for the stock market. Let me give you some levels here. I know it's a Friday, but Fridays have been volatile lately. So the levels you want to see on the SPY, let me go to a 5-day chart intraday. The levels you want to look on the SPY is 287.82. If we break above 287.90, 287, if we break above, let's say 288. If we break above 288, the market's going to become a little more bullish. So look for that number, 288 on the SPY. Looks like we're going to open right around 287.30. So there's a good chance we'll cross 288. If we do, we can expect more bulls to come into the market. I hope you have a great week. Don't make too much out of this inverse yield curve. It doesn't mean we're going to have a recession tomorrow. It can mean we can have a recession 2 years from now. And again, remember, the stock market has been extremely undervalued because bond yield has been so low. So there's a good chance we'll see more influx of capital come into the market over the next few months, especially if China and Trump work things out. And I believe they will. I think it's just a matter of time. I think it's going to happen before the elections because that's a card. The bullish market is a card that Trump wants to play. I'll talk to you guys later. You have a great weekend.